Quantum Cosmos presents Certified Financial Guardian, a seal of ethical selling. Privileged to bring you Chirag Mehta. Chirag is a senior fund manager at Quantum Mutual Fund. He specializes in the field of alternative investment strategies with 15 years of experience handling commodities. He is the fund manager of Quantum Gold ETF, Quantum Gold Fund, Quantum Equity Fund of Fund, and the recently launched Quantum India ESG Equity Fund. He is also the co-fund manager for Quantum Multi-Asset Fund. Chirag has to his credit an MMS degree in finance and is a chartered alternative investment analyst. Chirag is also a part of Quantum's multiple path to profit events, and he regularly writes his column, The Golden Truth, where he offers his views on gold. Chirag, thanks for joining.
Thank you.
We'll discuss ESG investing, asset allocation, and gold, and why you need these in current times.
Sure.
We are a part of the larger ecosystem where sensible handling of the environment and social issues are essential in the path to progress. Along with that, the governance plays a very vital role, because for progress in its true sense, you need to govern well. So the ESG theme is growing globally and in India it's also catching up. And you recently launched the Quantum India ESG Equity Fund. Can you tell our viewers more about this fund?
Sure, absolutely. ESG, firstly, it's growing big because it is more relevant today, right? Governance has always been at the forefront of how we look at companies.
Right.
It has always been an important part. But if you see, environment and social factors have also becoming more and more important.
Right.
So just to step back and tell you what ESG is all about, ESG stands for environmental, social, and governance.
Right.
So what are we trying to do? It's an investment discipline where you factor in the environmental factors, the social factors, and the governance factors of a company in its business operations, and try to find out which companies stand out on all these factors. Why we need these factors apart from, because if you see, these factors are more non-financial in nature,
right,
but they do have a material impact on a firm's valuation.
Correct.
Like these will involve how a company responds to climate change, what are the company's policies regarding waste management or water conservation, how it helps its employees in terms of safeguarding them from accidents in the factories, what are their pay practices. This is all essential because only good companies will be able to attract talent, and therefore employees are an integral part of any company.
Right.
Governance has always been an important part. We have seen bad governed companies have failed significantly for investors.
Correct.
So ESG, though being non-financial, as I said, these factors, if you study financial statements, you will not find evidence of these things in those statements. But these are becoming more and more important because environment, if you see, climate change is for real, global warming is for real. These factors are having are changing the way the business operations are taking place today. Government is getting more serious in terms of climate change.
Do you really think so? Because on June 5, on World Environment Day,
Sure.
Prime Minister Narendra Modi in a Twitter post, a video post, he said, "We are," and I quote, "We are born and brought up in such an environment where nature is treated as God. We must think of ways of making the planet more clean and green. The rainy season is coming. Therefore, I urge you all not to only plant a sapling but also make arrangements for its care so that it can grow in coming years. We all must connect ourselves with the environment." You also expressed, "Our planet and environment is something we all cherish greatly. Today on World Environment Day, we reiterate our commitment to ensure a cleaner planet."
Absolutely.
Really? Because on one hand, we are seeing industrial waste being dumped into our rivers, city waste being dumped into our seas. Everything is getting destroyed. We are building coastal roads. Perhaps, maybe we don't need those coastal roads. What's your view?
So if you see, let's begin with the last thing, the coastal road. It came across with a strong opposition from the community, right? Because community today is well aware, thanks to social media, that this is harmful in terms of what impact it can have on the city, right? Not now, but years down the line, it will have an adverse impact on the city. And therefore, there was a strong opposition which went to the courts, and the work was stopped, right? So these things that were earlier tolerated are no longer being tolerated, right? Even if the government wants or doesn't want, voluntarily or forcibly, it will have to act on environmental front. Why? because India is growing. It's the fastest growing economy in the world today, and it will continue to remain for next decade or two. That's what we believe. And if that is true, a byproduct of all that growth is going to be pollution, right? So the world is watching. So India has not been part of a climate crisis, but it has to necessarily be part of any climate solution, right? So the way India grows, it can not only impact India emissions or India pollution, but it will impact global pollution levels significantly. And therefore, the world is watching us. Government is under severe pressure. That is why the commitment to reduce or halve our emissions by 2030 by the government, and we are being monitored. If you don't achieve that, we will be under severe pressure. And therefore, if the government is under pressure, the companies and consumers, the owners will be passed on to them, right? And therefore, if companies are not foreseeing those risks and say that environment, I take it for granted, and labor is just a cost factor, it's not going to be tolerated anymore.
You mean to say L&T did not take any of these factors into consideration because they were a major player in this coastal road project?
Yeah.
So how are you going to, my question is, how are you going to build the portfolio while you're going to assess all these qualitative factors? How are you going to go deep down and understand these qualitative factors, because they are not really available initially in the public domain? So what are the care, and how are you going to do a bottom-up kind of approach?
Yeah, so as you know that ESG is a measure of sustainability in a way, right? It gives you the way the company ranks on ESG, tells you about the quality of the management that persists at that company. And we need to see what kind of practices that they adopt. So if they are building a growth project, whether they are doing environmental assessment of it or not. Because we have seen global examples, though it being a government project, companies that have built government project and something's gone wrong with the project years down the line, the company had to pay heavily for those things of the past, right? So if the company is not geared to looking at these things, then we penalize those companies, and those companies will not make it to the portfolio, right? So we look at each and every aspect of E, S, and G in detail and see what are the practices the company adopts in each of these areas. And therefore, if they fail on any of these areas, we see red flags, they don't make it to the portfolio. So that's the approach we have. So, but believe me, even today we cover more than 100 companies on ESG. There are many good companies in India that go beyond the traditional remit, and they disclose a lot more information. They do what they say, and therefore they are truly good companies.
Like if you see amount of transparency.
Absolutely. So if you see even cement companies in India, they fare much better in terms of the environment, like the energy usage, or be it water conservation, or be it pollution level, the clinker factors. They fare much better as compared to the global peers. Right. So you truly have good companies in India. It's just about how you identify them and rank them accordingly and position them in your portfolio accordingly.
So if if the auto company starts following the BS6 norms, will auto companies be a part of your portfolio?
So auto companies in India have never shied away from taking care of the environment. Like government said, we have to move from BS4 to BS6. They said, yes, we will adopt it. Right? Despite the slowdown they are seeing because of the transition being one of the factors of impact, they have said that we will move to BS6. Right? So auto companies, I think there are many good auto companies in India. And they have been taking care not only of the environment, but also of the social factor, and the governance standards are very high in these companies. And whichever companies qualify for us will make it to the portfolio.
So what do you think corporates and institutions, along with the government, what needs to be done to impact people's life in a positive way, where they create jobs, build livable cities, and not really smart cities, which don't mean much to anyone? And where the society at large benefits in its true sense, and we really see Achhe Din.
Absolutely.
Because there are CSR funds, but along with CSR funds, there are alleged diversions of CSR funds as well. So what do corporate institutions and overall, along with the government, what needs to be done so that we really see Achhe Din?
So when you look at CSR, though it is part of governance in terms of every company has to spend 2% of their profits to CSR, but we do measure as a S factor, a social factor. We do see what kind of spending that the company does, what is the percentage of spending that they are doing. what are the activities? For example, if they're doing a lending to a school, for example, and if it is a school where only rich people's children study, is that really CSR?
Absolutely.
It's not, right?
Yeah.
So we need to see what kind of spending they are doing and evaluate, because there are good corporates, there are bad corporates. There are good corporates who do their beyond what is needed and really help the community in which they operate. They need to have a stakeholder engagement program. Like if you're doing something for a particular area or a particular community where you operate, then you need to engage with them and what are the needs of those people, what they really want. Do they need a hospital? Do they need a school? What are the needs they really aspire for?
Correct.
And what they need? And therefore, they need to work in that direction rather than just doing a CSR by donating to a political party or doing a contribution towards a school where only rich children study. So those are not really CSR.
Okay. So if you had to do a top-down kind of an approach first, just to shortlist companies, what kind of sectors you'll be looking at broadly? So
the approach that we have for the ESG fund is to have a well-diversified portfolio firstly. So we look at a well-diversified index as a reference point to have a diversification, but we do not dilute the ESG aspect. Because ESG is at the forefront of what we are doing in this fund, but we need to ensure diversification as well, right? So we look at as a reference point a well-diversified index, so we know what kind of sector allocation we need to have. Firstly, we'll try to achieve it provided ESG supports it. Another factor that we see is liquidity. We need to buy only liquid stocks, because sometimes what happens is our buying takes the stock price up and our selling brings the stock price down. So unless the stock is liquid enough, our buying and selling should not impact that stock. And therefore, we buy into liquid names. Any stock that trades $1 million a day on an average for last 12 months is eligible to be part of our universe. And from that universe, we look at stocks which are ESG compliant. Any stock which has a positive ESG score based on our research will make it to the portfolio.
Okay. So most of the process is similar to what you follow in the quantum long-term equity fund, value fund. So how will the quantum long-term equity equity ESG India fund portfolio be different from the quantum long-term equity value fund portfolio?
So largely, if you look at the long-term equity fund, it is looking at valuation in a big way. They have a strict criteria in terms of what levels they will buy in and what levels they will sell to. Here what we are doing is we are in a way value agnostic. We don't look at valuations of company. ESG is what is the driving force in terms of what stocks we buy. So one is diversification, one is ESG, and therefore since we have a all-round diversification across sectors, there will be some pockets which will be going through cyclicality in terms of economic performance. But since you have a diversification, some other sectors will be making good on that part. And that's our risk mitigation in a way, having a well-diversified approach. And ESG is the driver of returns. The sustainability of these companies is going to be the driver of returns. So if you break it into a factor exposure, like you generally have, if you break a portfolio into a factor exposure, like the long-term equity fund will have a value factor exposure within that. This will have more quality and low volatility as a factor exposures. If you break any ESG fund globally also, the traits of an ESG fund that you generally find is quality and low volatility.
So what is the market capitalization segment in the ESG which you're currently looking at?
So market capitalization will be across market caps. We are not market cap biased. We are market cap agnostic. We will be looking at any company, be it from the small cap, mid cap or large cap space, and ESG compliant will make it to the portfolio.
Okay. And what should be the investment horizon in an ESG fund for an investor?
So in this fund, if you see, it's a more long-term oriented fund where we are banking on sustainability as a driver of return, and true sustainability stands out in a long-term cycle, right? There could be cyclicality which may be at play currently, but over a long term, these companies will truly stand out. And therefore, anyone looking at a horizon of 5, 7 or more years, that's the kind of time frame that one should look at.
All right. Okay, just moving away from ESG, let's talk about a quantum equity fund of fund.
Absolutely.
How is this fund different from the other fund of fund funds which are available in the market, and what are the exclusive benefit it offers investors?
Absolutely. So if you see the rationale of an equity fund of funds is why does one investor come to a mutual fund? because they don't have time, inclination or expertise to invest in stocks, and therefore they choose a fund manager, a professional for their investments, right? Similarly, if someone doesn't have a time, inclination, expertise to select a fund for their investments, then they come to an equity fund of funds, right? So that's the simple rationale and extension of why people come to a mutual fund, and therefore they should come to an equity fund of funds, right? Firstly, apart from whatever fund of funds that operate in the country, this is the only pure equity fund of fund available today. There is no other pure equity fund of fund in the country that's there apart from quantum equity fund of funds. So that's the uniqueness. Secondly, there is no conflict of interest, because if you see, we do not invest in quantum funds, and therefore there is no biasness or no conflict of interest involved. It's truly research-backed product where we do extensive research, not looking at only the track record, but looking at the portfolio characteristics as well. We dissect the performance in various ways to see if the fund manager is truly consistent performer or not. So we are banking on consistency rather than just looking at the top performers today, and therefore choosing fund managers that will deliver over the long term, right? So in a truly way, for the IFA community or the distributor community, how this is helpful. If they leave the fund management or choosing the funds on us, we will deliver a portfolio to them, and they can instead make good of the time by looking at the financial allocation or asset allocation needs of the investor, understanding the investor better, understanding his risk appetite better, and therefore arrive at an asset allocation that serves the goals of the investor. And therefore leave the expertise of choosing funds on us, and we'll deliver the equity allocation needs for them. You know, so it's a win-win for both, actually.
The only deterrent which plays is the taxation angle, that they're treated as non-equity funds. And maybe that's why IFAs are not promoting that. And there were expectations from Sitharaman this time in a full budget that there would be something on treating fund funds as equity funds. They
did something to that extent, but they did only the equity ETFs as equivalent to a fund of equity ETFs as equity taxation. But this still remains a debt taxation. But it's not bad. Let me tell you, it's not bad. It's equivalent or at par or even better than equity taxation if your horizon is 3 years or more.
You enjoy the indexation.
Indexation benefits, yes. When the indexation benefits kick in, we have seen that the taxation that it comes down to, it's about 8-9%. So equities are today taxed at 10%, though you get that 1 lakh exemption. But beyond that, you are taxed at 10%. Here, when you look at 3 years and above, and when you calculate your tax with indexation benefits, it comes down to 8 to 9%. That's what we have seen in the past. So if that is true, then this brings you at par or better than equity taxation.
All right. Let's move to gold. The year 2019 is all turbulent, and central banks are chasing gold. Modi's full budget was not very appealing. It failed to impress the market, with the FPI now being taxed with the FPI tax or the super rich tax. So turbulence seems to be inevitable in 2019. It's not going to be a smooth sailing. So how do you think gold will fare in 2019? Will it be double-digit returns, single-digit returns?
So far it's been a good ride for gold this year. Even on a 1 year basis, it's doing much better than any other asset classes here. So, and whether it's fundamental or whether it's kind of bubble that we are seeing is the question that many are wondering. But I think gold has come out of consolidation of like 6-7 years. It peaked in 2012 and we are in 2019, so it's come out of a consolidation of a very long time. Before that we had a great rally in gold, and after consolidation now it's moving higher. And I think the drivers today that we are seeing are all fundamental led, right? If you see, the global world is slowing down, and the response of central banks globally has been to pump and cut the rates first, and then they will look at pumping more liquidity. If you see today, about 15 trillion of debt globally is negative yielding. US academicians are also saying that we will not shy of going negative rates if it comes to that, right? If the crisis hits on us, then negative rates is not something we will not look at. Rather, they thought that they stopped last time, much short of what more they could have done,
Correct.
and they could have done negative rates last time itself.
Right.
So I think they might be more aggressive.
And they started by reducing rates by 25 basis
yesterday.
points.
Yeah.
Yesterday. All right. So where do you see gold in rupee terms? Because on one hand, the custom duty on gold has increased to 12.5, not so good for people who are going to buy gold. There is GST on gold as well. So will people continue to show their entrenched affinity for gold in India, given the fact that we are just heading to a festive mood and festive season now in few days?
Sure. So if you see customs duty, we have seen as low as 100 rupees, and it's now a percentage, which is, so it was like 0.5% to 1% kind of levels. It's now 12.5. VAT, which was 1%, is now GST 3%. So these taxes have always been part and parcel of India gold rates.
Right.
But that's not deterred the gold buyer to go ahead and buy it, because these are part of the price of gold, and therefore when you buy you pay it, but when you sell you get it back, right? It's part of the price,
right.
And therefore I don't think that even one has to pay today. It doesn't matter if the rates stay where they are, they will get it back when they sell it.
Correct.
So I don't think that's a deterrent. Usually people come in after a good rally is over, so I will urge investors listening that these are really turbulent times, really full with uncertainty, and if you see the drivers today for gold are very real, very fundamental led, and therefore if you don't have your gold allocation of about 10% of your portfolio, then you need to build it right now. And
so, as a fund manager of Quantum Gold ETF and Quantum Gold Fund, are you seeing that shift in consumer behavior? People are investing in paper gold, or you still have to convince them? And if you have to convince them, how do you go about it?
So yes, despite being about 10 plus years of gold ETF in existence, the awareness of gold ETFs is still lower. Because still, I think people should move towards this side of buying gold, towards gold ETF, because they are very, very price efficient.
Right.
Imagine a retail investor buying half a gram of gold at prices where tons and tons of gold get exchanged between a gold producer and a bullion bank. That's the efficiency that gold ETFs bring from that wholesale level to the retail level.
Correct.
Right? And therefore it makes it a really price efficient vehicle. You don't have to worry about liquidity. They are available anytime. You just buy it like you buy any equity share. You just buy it sitting at home. So it's really convenient for investors to go ahead and buy and allocate to gold today. Plus they don't have to worry about purity, because many times you buy physical gold, it's there is a high probability that there could be some elements of impurity within that, right? And you're paying for the gold rate for that impurity. So here they don't have to worry about that. They don't have to worry about storage. Even at the personal level, if you want to insure, it's very difficult or not possible at all to insure your gold. Whereas we as a fund house insure all the gold. So it's very, very safe in terms of the gold that we buy and hold. So this is a better way of buying gold, and I think investors should awaken to this fact and stop buying physical gold, at least when it comes to investment. Because many people buy gold when it comes to investment in terms of physical gold, and it's very, very inefficient. When it comes to jewelry, you don't have a choice. You have to buy jewelry.
Unless you're buying for your daughter or son.
Absolutely. If you're accumulating, then this is a great product. Gold ETFs, the gold saving funds, are the best product for accumulating gold. And even if you want buy for investment purpose, this has to be your choice.
So asset allocation, gold will play a very critical role.
Absolutely.
So should investors consider Quantum multi-asset fund?
Absolutely. So what does multi-asset fund do? Multi-asset fund allocates across equity, debt and gold depending on the attractiveness of that particular asset class at that point in time. Right? So we'll keep changing allocations. If equity becomes expensive, we'll come out of equities and be in gold and debt. Right? If equities are very cheap, we'll get into equities from gold and debt. So that is how we try to play the economic cycles that we see in each of the asset class. Right? So if someone doesn't, people ask us, how much should I allocate to any asset class? I don't have any particular time frame or a goal. I just want to be in the best asset class at that time.
So technically, Quantum multi-asset fund plays a critical role.
Absolutely. So if you're not sure if you're buying for the long term and want to have exposure, which you should have a diversified exposure to all the asset classes, then multi-asset fund is a great way to do it.
Okay. All right, Chirag, many thanks for your valuable
Thank you
insights.
so much, Rounaq.
I'm sure the IFA community will benefit from
Absolutely.
these. Thank you.
Thank you so much.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.